Welcome to the deep dive. Today, we're really digging into something critical. Building wealth when, well, inflation seems to be changing all the rules.
That's right. We're focusing on Robert Kiyosaki, the rich dad, poor dad guy.
Exactly. Specifically, his three, let's say, unconventional rules for not just surviving, but actually thriving when prices are rising fast.
Yeah, and the sources we've looked at, they give a really clear, almost provocative framework.
Mm.
Kiyosaki basically argues that the old advice, work hard, save money, avoid debt, it's, well, potentially disastrous in today's world.
Mm-hmm.
This deep dive is really your shortcut to understanding his specific angle on things like debt, taxes, cash flow. They're sort of the main pillars.
Right. So our mission here is to unpack these three rules.
Yeah.
We want you to understand why just earning more might not be the answer and what shifts Kiyosaki thinks are absolutely crucial. Okay, let's get into it.
Let's do it.
We start with maybe the most jarring part of his philosophy, this idea about tax and debt, the paradox.
Yeah, Kiyosaki often points back to 1973. He'd just gotten back from Vietnam,
Oh.
and his rich dad gave him some pretty specific advice. Forget traditional business school stuff for now, he said. Focus entirely on real estate.
But not just buying houses, right. It was deeper than that.
Exactly. The goal wasn't just ownership. It was about mastering the rules around debt and taxes. And that really forms the basis of his first rule. The core idea is this. Debt and taxes, the way the system is set up, they actually make the rich richer. But those same mechanisms, they make the middle class and the poor, well, poorer.
Okay. How does that work in practice? Is there an example?
Well, the source gives a pretty stark one. Think about a high earner, maybe a doctor making, say, $1 million a year.
Right. Sounds great.
Sounds great, but then come the taxes, federal, state, maybe local.
Right.
It's not uncommon for them to pay, let's say, $600,000 or even more straight to the government.
Wow. So they're left with, what, $400,000? Maybe less?
Precisely.
Yeah.
It's a huge hit. That $1 million income looks very different after taxes bite. The effective rate is just crushing for high W-2 earners.
Okay, so that's the employee or the professional. How does Kiyosaki approach it differently?
So as an entrepreneur or investor, his goal is different. If he legally brings in $1 million, the objective is to keep that million. Or, well, as much as legally possible. By immediately moving it into specific types of investments, particularly assets where the expenses related to acquiring and managing them can be deducted before taxes are calculated, not after.
Okay. And this is where real estate comes back in strongly.
Exactly. He highlights real estate because, number one, the money invested gets certain tax advantages. But number two, and this is key, he uses the bank's money, leverage.
Right, the famous line for every million he invests, the bank adds 4 million.
That's the claim. He calls it leverage, using other people's money, or OPM, and he says that's why he loves the bank, because they provide this capital.
But how does that help with taxes specifically, the leverage part?
Okay, so think about it. You borrow that $4 million to buy an investment property. The interest you pay on that loan, generally it's tax deductible.
Okay, makes sense.
But there's more. You also get to deduct something called depreciation. This is like an accounting allowance for the property wearing out over time, even if its actual market value is going up.
So it's a loss on paper, even if it's not a real loss.
Exactly. It's a phantom expense in a way.
Yeah.
And those deductions, interest, depreciation, other operating expenses, they can drastically reduce the taxable income generated by the property, sometimes down to zero, or even creating a paper loss you can use against other income.
So that borrowed 4 million becomes tax advantage capital, used to buy assets that hopefully go up in value and produce income?
You got it. Now connect that to inflation.
Right.
When banks lend that $4 million, they're essentially expanding the money supply. The investor, the borrower, like Kiyosaki, benefits because they're using this newly created money to acquire hard assets.
While the person just saving cash.
The person saving cash in the bank. They're holding a fixed amount while the value of each dollar is potentially going down because more money is being created. They're kind of penalized by the very inflation that benefits the leveraged borrower.
Okay, but I have to ask, isn't taking on millions in debt incredibly risky? I mean, what happens if the market turns or you can't find renters?
Oh, absolutely. It's definitely risky. Kiyosaki acknowledges that financial education is critical. His point isn't that debt is good universally, but that the rules of the system, especially tax laws, are structured to favor knowledgeable investors who use debt strategically.
So, rule 1 boils down to?
Don't just work hard for a salary because you'll pay heavy taxes on it. Instead, focus on acquiring income-producing assets. because assets give you more financial control over your income, your expenses, and crucially, your taxes.
Okay, that idea of assets giving control leads us right into rule number 2, which is,
Simple phrase, profound implications. Don't work for money, work to build assets.
and understanding this starts with looking at your own finances, right? Your personal balance sheet.
Exactly. Rich Dad apparently taught him 4 key financial words: income, expense, asset, and liability. And Kiyosaki insists that the real secret to getting rich isn't just having high income. It's about controlling the cash flow between these 4 categories.
Right. And I think a huge confusion for people comes from the word asset. We tend to think, my house is my biggest asset, my car.
hmm The traditional definition is anything you own that has value,
Yeah.
but Kiyosaki throws that out, at least in terms of wealth building.
So what's his definition?
It's purely based on cash flow. An asset capital A is something that puts money in your pocket whether you work or not.
Okay. Like a rental property where the rent coming in is more than the mortgage, taxes, and expenses going out.
Perfect example. That extra cash flow lands in your pocket each month. That's an asset.
And a liability.
The opposite, something that takes money from your pocket.
Yeah.
So that house you live in, you pay the mortgage, the property taxes, the insurance, the repairs, money flows out every month. In his framework, it's functioning as a liability.
Even if it's going up in value.
Even then, because the monthly cash flow is negative, it's taking money from you. Now, it might be an asset you can sell later, but in terms of building ongoing wealth, it's the cash flow that matters day to day.
Okay. That cash flow distinction really clarifies things. It also explains that trap you mentioned earlier, the high income trap.
Yeah, he uses a kind of graphic analogy, compares it to financial diarrhea.
Okay.
The idea is most people, when they get a raise or a bonus, what's the first thing they do?
Upgrade. Bigger house, newer car.
Exactly. They immediately increase their expenses and often take on more debt to fund that lifestyle upgrade. So the extra money comes in and bam, it flows right back out again to service the bigger mortgage, the car payment, the credit card.
It never gets a chance to build up or be invested.
Right. There's no accumulation. They end up working harder just to maintain this bigger cage of liabilities they've built. They're stuck on the treadmill.
And this ties into where income actually comes from for different groups, doesn't it?
Absolutely. For most people, the poor and middle class, almost all income comes from a paycheck, salary or wages, highly taxed, as we discussed.
Whereas the rich,
According to this philosophy, the rich derive most of their income not from labor, but from their assets. Things like interest from bonds, dividends from stocks, cash flow from rental properties, profits from businesses they own.
income that often gets preferential tax treatment too.
Often, yes. So the action plan, the core of Rule 2, is surprisingly simple in concept.
Which is?
When money comes into your life, whether it's your salary, a gift, whatever, the first thing you do before paying bills or buying luxuries is put some of it into acquiring or building an asset.
Pay yourself first, but yourself means your asset column.
You got it. Funnel money into the asset column consistently. Then, ideally, you start using the income generated by those assets to pay for your expenses and your lifestyle. Let the assets pay the bills, not just your job.
Okay, Rule 1 was about understanding debt and taxes. Rule 2 was redefining assets and liabilities by cash flow. What's Rule 3 focus on?
Rule 3 is really about where you put your focus and your effort.
Okay.
The sources suggest that, maybe 99% of people focus almost entirely on increasing their earned income, working overtime, getting promotions, maybe side hustles.
All to make more money from labor.
Right. And usually that extra money goes towards funding a more expensive lifestyle, bigger house, fancier car, which, as we just discussed, are often liabilities in Kiyosaki's view. Their focus is on the income side to feed the expense side.
So what should the focus be, according to this?
Instead of maximizing salary to buy liabilities, the focus should be entirely on increasing the number and size of assets that generate positive cash flow.
So using your job income, your salary, to systematically buy or build things that will pay you later.
Exactly. You use your labor income as seed money for your asset column. You religiously prioritize building that asset base before you increase your spending. Over time, the goal is for the cash flow from those assets to grow large enough to cover your daily living expenses.
And that's financial freedom, right? It's not necessarily about being a billionaire.
Precisely. Financial freedom in this definition isn't some astronomical number. It's actually very specific to your lifestyle.
How so?
Let's say your average monthly expenses, your rent or mortgage, food, transport, everything comes out to, let's use the example's currency, say 30,000 units a month.
Okay.
You are considered financially free the moment your portfolio of assets reliably generates more than 30,000 units in cash flow each month.
So when your assets cover your lifestyle, you're free, whether that's 30,000 or 300,000?
Correct. It's a calculation, not a dream. It's passive income exceeding expenses. That's the target.
Now, this focus on assets, especially tangible assets, connects to another strong theme in Kiyosaki's work: his distrust of saving cash.
Oh yeah, he's famously critical of savers. He
Hmm.
often says savers are losers.
Which sounds harsh. Why such a strong stance?
It boils down to his lack of faith in what's called fiat currency.
Okay, break that down quickly.
Fiat currency is basically government-issued money, like
Yeah.
the US dollar, the euro, the yen, that isn't backed by a physical commodity like gold or silver. Its value comes from government decree and, well, collective belief or trust that it has value.
And Kiyosaki doesn't trust that.
His argument is that governments can and do print more of it whenever they want to fund spending, bailouts, whatever. And when you increase the supply of something, its value tends to...
Go down, inflation.
Exactly. Printing money erodes the purchasing power of each individual dollar or euro or whatever currency unit you're holding. So saving large amounts of cash in the bank, in his view, is like holding on to a melting ice cube.
So what's his strategy then, if cash loses value?
Immediate conversion. The moment he receives significant amounts of fiat currency, his instinct is to convert it as quickly as possible into a real, tangible asset that he believes will hold its value or even increase relative to the depreciating currency.
Okay, an example of that.
The source mentions his investment in silver. He apparently bought silver years ago when it was maybe $1.40 an ounce.
And today it's
Much higher. Let's say, for argument's sake, the source noted it hit $16 or more at some point. That's like, what, an 11x increase?
roughly, yeah.
Now, Kiyosaki wouldn't primarily interpret that as, wow, silver got super valuable.
Yeah.
He'd more likely frame it as, wow, the US dollar lost about 11 times its purchasing power relative to silver over that period.
Ah, I see. The asset held its ground, or gained, while the currency weakened against it.
That's the perspective. It's about preserving purchasing power against currency debasement.
And we can see that historically, even without thinking about specific assets like silver.
Totally. Think back maybe to your parents' or grandparents' generation. The source uses a Thai example, but the principle is universal. Noodles might have cost less than 10 birrel. Gold, maybe 4,000 baht an ounce.
Right.
Today, that 10 baht maybe gets you a tiny bite of noodles, if anything. And gold, far, far higher than 4,000 baht. It just illustrates how dramatically the value of basic currency can fall over time compared to real goods or traditional stores of value.
So holding cash long term, you lose buying power.
That's the core argument, especially in an environment where governments are actively inflating the money supply. Rule 3's conclusion is pretty firm. If you want long-term wealth and protection from inflation, you can't just hoard paper money. You need to own real, preferably income-producing assets. Hashtag tag answered outro.
Okay, that brings us to the end of our deep dive into Kiyosaki's 3, let's call them provocative, rules for building wealth, especially when inflation is a concern.
Yeah, just to quickly recap, Rule 1, understand how debt and taxes work differently for investors and entrepreneurs and learn to use those rules.
Rule 2, redefine assets and liabilities based strictly on cash flow. Does it put money in your pocket or take it out? And focus on building the in column.
And Rule 3, shift your focus from just earning a high salary to constantly acquiring tangible, income-producing assets. Don't just save fiat currency, convert it.
So when you boil it all down, what's the big takeaway for someone listening right now?
I think the ultimate message is that when inflation is high, or expected to be high, the traditional financial playbook really gets flipped on its head. It stops being about just earning and saving cash.
Right.
The game shifts. It becomes about acquiring and growing assets, things that generate their own income and tend to hold their value or even appreciate. While the currency itself might be losing ground, it's moving from being a consumer of money to an owner of assets.
That's a powerful shift in perspective. Okay, let's leave our listeners with something to think about based on everything we've discussed. If Kiyosaki sees saving fiat currency, saving dollars or euros in the bank as a losing strategy long term because it depreciates, what's one tangible asset, something real you can potentially hold or control that maybe you haven't really considered as an investment before?
Good question. Could be anything from a piece of real estate, maybe even a small vending machine, a specific skill set you can monetize, or even commodities like he mentions.
Something tangible. What overlooked opportunity might be out there for you? Something
Yeah.
to mull over. Thanks for joining us on the deep dive.
Thanks for tuning in.